Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 5th edition of Market Outlook. So, interesting market this week. We really had a serious reversal in commodities, which we'll get into in a moment. But meanwhile, a couple things to note. NASDAQ 100 and the Russells put in really good weeks. They had some additional accumulation days. The Russell's now up year to date 2.97%, with NASDAQ falling behind and staying behind, still down 1.6% for the year. However, what had been the leading index up until this week in terms of overall movement was the S&P 500. Now, it's still a leader year to date, but it certainly lagged and had problems in terms of volume. So both the Dow and the S&P 500, hard to find real volume and follow through, but meanwhile, the weaker performing indices picking up the rear this week. Okay, let's take a look at the sectors and if that is giving us any clue as to what the future direction of the market holds. Well, interesting, seeking yield with the utilities moving up along with the bonds. So utilities as the strongest performing sector this year, definitely sign of more caution on investors' part and seeking some type of yield. Utilities are conservative. They definitely have a good income stream, and compared to treasuries, which are very, very low, and of course the richness of the stock market, it's not surprising that the utilities are doing extremely well. Now, also picking up in second place is consumer staples. Again, consistent return. So more conservative plays in first and second place, really picking up the latter positions, but still in the upper end is semiconductors. That's more speculative. And of course, XLB materials, which includes the metals. So commodities and conservative plays are getting the attention this year. Very interesting. Meanwhile, overall, financials, transportation, and retail all having issues, as you can see. So if you look at the 6-month, it's pretty interesting. Just take a look at this. We've got 1, 2, 3, 4, 5, 6 sectors, right? 6 sectors that are actually down on the year. So you got a pretty mixed bag on the sectors in terms of up, down. And this chart over here really tells the story. We've got a few more sectors up than down, but overall, pretty mixed bag. So in terms of what the market's telling us, people are liking the more conservative plays and flocking into that. Hence, utilities are that leading sector. Let's go to a couple of other tables here. Well, first of all, what's really interesting, please note, gold miners right here, XME, metal and mining, and this week it was coffee. But if you wanted to look at the 6-month leaders, right, again, GDX. So the biggest gainers on Friday, GDX, in alignment with the 6-month trend, which puts it up 84% in gold miners. Metal mining, which is all metals in general, also having a banner day, up almost 5%. And again, if you look at the action, right, the biggest gainers over the last 6 months resumed its position of strength, because on Friday, metal miners picked up again. Now, I've been pointing out sugar as well, and you can see over the last 6 months, sugar has just really taken off, and it's one of the outperformers looking at all of our ETFs. That and utilities. So you can see conservative plays metals and commodities are definitely leading, which begs the question once again, is the Fed and the central banks behind the curve? With a poor jobs report on Friday morning, these 6-month leaders that had been lagging over the last couple of weeks pretty much took back virtually all of the losses or the retracement they had in almost one fell swoop. So that's pretty powerful action in terms of commodities and utilities. All right, let's take a look at some of the market internals and see what they're telling us. Okay, so what we have here is, take a look. Remember we were talking about up-down volume or volume in general. And you can see, even though we had an up week and over the last 2 weeks or so, not really able to make much progress on our up-down volume indicator. And in fact, couldn't quite hit really strong levels, and it's now flipped lower. Now, in terms of overall advanced declines, still very strong. So net, I'm looking at what I would call on the S&P 500, on the margin, strong, basically bullish, but slightly weakening based on up-down volume. So we're going to keep an eye on that. Overall positive, but a weakening scenario for the S&P on the market internals. Let's go to the NASDAQ composite and see what that's telling it. Similar story, interesting. On the up-down volume, we really got pretty overbought here, which actually is a good sign. When you get that overbought and hit the upper end of our bands here, which it did, that's usually a sign of strength. Look what happened. So it worked its way off and its overbought situation off by actually going sideways to up. So wouldn't be surprised to see a similar scenario. Now, in terms of the longer term view on breadth, which is advances versus decline, the McClellan oscillator, which is the middle graph, again, more sideways action. So the fact that we're over the midpoint, had been oversold, and just sort of going sideways as the market goes sideways, not unexpected. I call that a neutral. Now, what is really strong is this advanced decline. So net, I'm looking at a much improved scenario in the NASDAQ composite. Okay, moving on to the next chart. Another big improvement here, looking at the SPYs, again, new highs, new lows, hooking back around and getting to really strong and positive territory. When we see new high, new low ratio getting above that 70% level, that's really bullish, especially with it hooking around. And so that is definitely an increase in one of the indicators on the bullish side, which is interesting because as we noted before, the up-down volume light, but we're making more new highs and new lows on lighter volume. This indicator, new high, new lows for the spiders, definitely improving. Okay, regarding NASDAQ and the new high, new low ratio, really nice improvement, getting to really rich levels, which is a positive for the market, of course, until it starts hooking down in a significant way. But meanwhile, new high, new low ratio looking really positive as even the market had marginal sideways movement this week. So net, that's a positive on this market internals indicator. All right, let's go to our next chart. And we're going to look at sentiment here. As we noted last week, right, we were pretty much at the bottom, right down here, of the Bollinger Band. And this works, of course, inversely. We're at the bottom of the Bollinger Band and pretty much at lows, and these are pretty important lows. It goes back quite a period of time. That's frothiness. So in terms of the S&P, we basically closed up a little bit for the week. Lots of sideways action. Not surprised. So at this point, working off overbought sentiment readings by sideways action with price momentum and trend still very strong. Right? We're under the 200-day moving average, under the 50-day moving average. Everything is pretty much in gear. Now, looking again at another sentiment indicator, you can see we've been trading sort of in this, let's take a look here. We've been trading in this sideways channel here, right? And basically trading above our bullish level. So it's not extremely overbought. The actual price or the actual ratio hooked back over into bullish territory. So again, until we really break beneath these levels or get above and start touching all the way up here, which is a ratio of 1.3, that would indicate to me extreme bullishness. So right now, again, this is more of the market is running strong. Volatility and sentiment is not excessive relative to its action over the last several months, going back to March, sort of in the mid part of the range. I consider that more of a positive than a negative. And again, we did hook back up this week. So net, overall improved market internals on the NASDAQ composite, the NASDAQ 100, slightly decreased in the S&P. So overall, more positive than negative on market internals, being supportive to the market at the moment. So that's it for now, and see you next week.